Indian stock market reversed course after ending in the red for 3 consecutive sessions. Headliner Nifty gained 0.3% while the 30-share Sensex surged about 0.4%. However, if you look at the broader markets, they continue to remain under pressure with the mid-cap index ending 0.25% lower and the small-cap index closing with a cut of almost 1%. Fear indicator India VIX also corrected sharply, falling 6.5%, indicating some semblance of stability in the market. But should you trust this recovery? Is the worst behind us? And why were the markets correcting in the first place? Plus, what sector should you be looking at during this dip and which ones should you steer clear from? To break it all down, we are joined by Mohit Gang, co-founder and CEO of Moneyfront. Mohit, thank you for giving us time here on News9, sir. Now, Nifty and Sensex witnessed a healthy recovery in today's trade, but prior to today's bounce back, they had been correcting for the last 3 sessions. The broader markets, they are much worse off. They didn't even participate in today's recovery. What do you think are the factors that were leading to this stock market correction?
Okay, look, Suresh, so I think it's not any longer a news that the markets were highly overvalued, right? You and I have spoken about it, and I'm sure you've spoken to multiple other guests on your show, explaining that markets were fundamentally stretching out a lot, extremely highly valued on some sectors, some zones, some pockets of market cap. And those were actually getting scary to a certain extent, right? If you ask me, has there been any negative news flow around the market for last 10, 15 days or last week or so? Nothing. Honestly, nothing. I don't think so. Globally, there has been an event, or there's been an event of significant proportion in US per se, which kind of scares us out. It's just that markets were running too fast and in too quick a time. And to my mind, this is just it's just kind of a small correction, which possibly is very good for the markets, which is healthy at times. It just cleans up fraud in certain pockets of the market and just squares up everything, right? So I think honestly, it's good for the overall health of market.
Do you think the worst is over, or can we see some bit of more correction from here on? And if it's the latter, what are the triggers that you'll be keeping an eye on?
Okay, so honestly, if you see at the headline number, the Nifty and the Sensex haven't corrected much. The mid and small caps, yes, they have taken some amount of beating on the chin, and some sectors and some pockets, as I said, have taken quite a bit of belting from the markets, right? And let's say, especially the PSU sector, or maybe defense to some extent, and some railway stocks, and few other pockets which were running too fast have actually gone through a correction. Now, how far can that go? Look, honestly, that's anyone's guess. My sense is markets never stop at the equilibrium level. They tend to react in extremes, either on the upside or on the downside, both ways, right? So I don't think that this short-term pain is over in the market. My sense is we can still see some bit of further correction or further consolidation in few pockets of mid and small cap. Having said which, the market is showing clear divergence. If you see the Nifty and Sensex, or the headline, or do you say the large caps and the mega caps, they've been fairly stable. We haven't seen much correction out there. The IT pack is standing out. It's just actually giving some positive impetus to the market. The pharma is standing out, right? And few of the heavyweights are pulling their weight. If the heavyweights banks chip in, honestly, and I think then the markets will find strength in some other corners. So my sense is market A is consolidating in overvalued zones. B is finding solace in few of the safe corners, which could be consumption corners or quality related stocks, or which could be pharma related stocks, and so on and so forth. So my sense is market is finding stability in those pockets, and perhaps this is like the seasonal sector rotation which is happening in the market at the bottom, and we all will only come to know of it once it is totally done and out.
All right. Mohit, does it make sense for investors to continue favoring sectors like IT and pharma that have bucked this trend of market correction? Or would you say it makes more sense to look at sectors that have taken a beating in this correction, like the PSUs?
Look, this all depends on one's trading strategy and philosophy. Honestly, if I as a trader am a momentum trader, then I will definitely go for stocks and sectors which are breaking out at this point in time and which are showing strength and not falling so much in this correction and not correcting, right? But if you are someone who is more a long-term fundamental guy who likes value picks, who like beaten down picks, and perhaps have the patience to wait out when the time again comes in, then maybe the other approach works well, which is trying and buying more on dips where you have the fundamental conviction underlying, right? But I'm more of a former one, which is trying and going with the winners and trying and thinking of sectors which are showing breakout and showing positive strength at this point in time. So I will go with that.
Now, one of the main reasons for this correction, or at least the correction of last week, was fears of recession in the US. A lot of investors pointed out that US could be heading towards a technical recession if the SAM's rule is triggered. Now, assuming if a recession does occur in the US, how will it impact India? What sort of a percentage correction can we expect in that case?
Look, honestly, Suresh, I find it very fascinating that every time there is a new philosophy which comes up around the US market. First, for a long while, I was hearing the inversion of the yield curve, and
Hmm.
when now that the yield curve is back to its normal shape, now I'm hearing the SAM's rule, and then I keep hearing about the Fed cutting rates and possibility of a hard landing and so on and so forth. It's a fascinating story, but it's got to be, look, because US is the largest market, it draws the most amount of attention, and it is the what do you say, fulcrum of everything which happens across equity markets across the globe. My sense is very simple, and my two bits on this is that I think market is keenly anticipating the US Fed action on 18th of September. If we get, and markets perhaps has their own way of pushing the Fed in a manner or nudging the Fed. So markets is trying and telling the Fed that we need a 50 bips correction, we need a 50 bips rate cut, right? And you never know. 25 bips is totally factored in. It's totally factored in. It doesn't ring a bell anywhere, right? And perhaps that's a status quo scenario. At 50 bips, markets will be a little pleased, a little happy, and perhaps everything will start looking hunky dory again. I think currently the rate cut anticipation, which they track in US, has reduced from 35 bips to 30 bips. If I hear it correctly, so I'm not sure. And market and the signals are also mixed. Look, you had the non-farm payroll data, which was lesser than expected. Then you will have the unemployment data, and there are a lot of other data points to be watched keenly, right? So the signals are mixed, which doesn't like really indicate that Fed will go all out and start with a 50 bips kind of a rate cut. Having said which, if they start, then I think that's a positive for the market, and perhaps market will find anchor at that level. But otherwise, honestly, I think it might remain a bit choppy for the markets for a while. But just the signal from Fed that the rate cuts have started, the initiation of the rate cut should be a good enough positive trigger for equities on the whole.